At the very least, since the 1700s, economic contexts have been home to pump-and-dump schemes, which involve the fraudulent manipulation of prices by disseminating false information. For example, con artists who owned shares in the South Sea Company began spreading false information about the company and the earnings it generated at the beginning of the 17th century. Before selling the stock to naive customers who would be duped into thinking they were investing in a promising good, the goal was to raise the stock price as much as possible artificially. Con artists in the modern day follow their lead by using a pump-and-dump method commonly referred to as the South Sea Bubble. But as a result of developments in blockchain technology and the proliferation of cryptocurrency trading, the problem has grown in scope and severity in recent years. Since government regulation has trailed behind other industries, cryptocurrencies are especially vulnerable to this form of market manipulation. Welcome to Crypto News. Today, we will discuss crypto pump and dump groups. Stay with us until the end of the video to learn more. Like and subscribe to this channel and hit the bell button to get notified of all the latest updates. Let's jump to the topic. How do crypto pump and dump schemes get started? Although this is not always the case, a cryptocurrency pump and dump scheme frequently begin on social media platforms like Facebook, Twitter, or Instagram. Discord channels are also popular places to launch these scams. After all, these scams rely on creating a lot of buzz and curiosity about the new coin. There is no better way to accomplish this than with a persuasive social media post or message. Scammers would typically promise massive growth in a short period and frequently lie about what the cryptocurrency seeks to do and who or what is affiliated with the coin, such as the Squid Game coin. The unscrupulous actors may also recruit influencers or others with a strong social media presence. They may pay these celebrities to speak positively about cryptocurrency. This will generate a lot of buzz or at least attention. For many, the proceeding will cause severe FOMO, fear of missing out. They'll then buy some, or a lot, of the advertised coins, causing the price to skyrocket and launching the fraud. What is a crypto pump and dump scheme? The simplest approach to identifying a pump and dump is understanding its mechanics. If the value of a relatively unknown coin suddenly climbs for no apparent reason, there is a significant possibility that manipulation is at work. It's usually a good idea to research before making a purchase. Avoiding rushing into a project before conducting an adequate investigation. You may lose some return if you wait a little longer to invest, but having greater trust in your investment will provide you assurance in the long run. In the case of a pump and dump, the extra time may even spare you from being stuck with a wallet full of worthless coins. Finally, here are the 5 most important symptoms to look for. Keep an eye on price movements. Sharp price changes are a key element of pumps and dumps. While price swings can occur with any coin, pump and dump is a concerted operation by a group of schemers. The value of a coin rises swiftly for no visible reason, then falls rapidly for no discernible reason. A coin's price chart can reveal a lot about its volume fluctuations and price history. Online trackers can also warn you of suspected pump and dump schemes. WalletInvestor.com monitors any increase above 5% in a 5-minute period to alert users to potential scams. Source of promotion. Pump and dump scams are frequently orchestrated in internet chat rooms. Following well-known pump and dump organizations is possible, albeit some may charge for timely information. One of these groups can have as many as 200,000 people, whereas smaller groups can have as few as 2,000 people. Such methods are frequently coordinated through relatively anonymous and secret channels on Discord and Telegram. Groups that provide crypto trading signals may engage in pump and dump operations. They're attempting to attract newcomers with little trading experience. They may charge money for their trading signals after gaining their trust, but it is impossible to tell where those signals come from and whether manipulators generate them. Influencers come in a variety of shapes and sizes. Be wary if a random influencer with a questionable past and no Bitcoin experience suddenly starts pushing a coin. Many promoters may also make guarantees about returns. Be skeptical of claims of free money or high returns. If something appears to be too good to be true, it typically is. Maintain an eye on the trading volume. Thin liquidity, also known as thin trading volumes, indicates that order books aren't filled with enough buyers and sellers to keep pricing stable. Market makers may not be interested in a specific name enough to keep placing buy and sell orders. As a result, the price can easily exceed normal levels, especially in a short period. Any asset with a small number of orders is more vulnerable to pricing and trading manipulation. Capitalization of the market. A coin's market capitalization is computed by multiplying its price by its supply. Pump and dump organizations usually target low market cap coins since coins with lower supplies often have less trading activity. Smaller currencies are vulnerable to price manipulation by gangs of bad actors. Regulations. Less regulated exchanges are also more vulnerable to pump and dump operations. Pump and dump strategies are detected comparatively more frequently on exchanges Binance and Bittrex than on heavily regulated US-based exchanges, according to analysis. Price and volume surge frequently occur on a single exchange rather than across multiple exchanges. If you notice any of the indicators mentioned earlier, you are most certainly witnessing a pump and dump. Can you make money from a crypto pump and dump? Pump and dumps cause enormous price movements, which can result in large gains. Profiting from pump and dumps is achievable, even if you don't realize it if you're on the right side of the deal. If your timing is off and you catch the wrong wave, you may struggle to profit from pump and dumps. Identifying a pump and dump technique necessitates having enough faith that the organization you're following will be first to market and artificially raise prices. You must also be able to exit the deal in time to profit. Set a trailing stop loss to limit your losses, which allows you to quit a trade if prices fall suddenly. This entails placing a sell order at a predetermined price to limit your losses and removing your stake in the coin. Otherwise, if you hold a position for too long and leave slowly, you may become a victim of the dump's declining prices. Is it illegal to use a cryptocurrency pump and dump? With all the talk around cryptocurrencies, why aren't there rules to safeguard consumers? Yes and no, respectively. In most nations, there are prohibitions against intentional deception. For example, the Federal Bureau of Investigation, FBI, has an Internet Crime Complaint Center that monitors online fraud in the United States. However, due to the nature of cryptocurrencies, determining which body regulates them is difficult. Depending on the regulatory agency, a cryptocurrency might be classified as money, property, security, or a commodity. This means it is overseen by one of the following agencies: the Internal Revenue Service, IRS, the Commodity Futures Trading Commission, the Securities and Exchange Commission, or the Financial Crimes Enforcement Network, FinCEN. If you made it to the end of this video and are interested in knowing more, let us know which part of the video you liked the most in the comments section below. We will appreciate your comment and work to make a video on your desired topic with an account shout-out. Please like and subscribe to the channel and hit the bell button to be notified of our next video. Thanks for watching.